Today, we're diving deep into one of the most interesting deals in the pharma world, Merck's acquisition of Cidara Therapeutics. Why did a giant like Merck shell out billions for this company? The answer lies in one groundbreaking drug candidate, CD388. This isn't just another business deal. It's a strategic move that could change how we fight the flu forever, especially for the most vulnerable among us. Stick around as we unpack the science, the market, and the money behind this massive acquisition. So what's the big deal with CD388? Imagine a flu shot that works differently. Instead of training your immune system, which can be hit or miss, CD388 delivers direct, immediate protection. It's a long-acting prophylactic, meaning one dose is designed to protect you for an entire flu season. This is a game changer. Here's how it works. CD388 combines a powerful flu-fighting component with a special fragment. That makes it last a long time in your body, and the best part? Its effectiveness doesn't depend on how strong your immune system is. This makes it a potential lifesaver for people who don't respond well to traditional vaccines, like the 𝗖𝗜𝗗𝗏𝗧𝗫 and adults over 65. Think about the unique benefits this offers. First, protection is immediate. No more waiting till weeks for your body to build up antibodies. Second, it's designed for a single seasonal dose. Super convenient. Third, it's strain agnostic. That means it doesn't need to be reformulated every year to match the latest circulating flu strains. It provides broad coverage against most types of influenza A and B. This predictability is huge. With vaccines, effectiveness can vary wildly from person to person and season to season. CD388 promises consistent protection, potentially slashing hospitalization rates for high-risk groups. And the data backs this up. Phase 2 clinical trials have already shown strong results and a good safety profile over a 6-month flu season. Regulators are taking notice, granting it fast-track status as it moves into larger Phase 3 studies. Now, let's talk about who needs this. The market is enormous. Every year, millions of people get the flu, and for some, it's a very serious illness. Current vaccines, while helpful, often fall short for those with weakened immune systems or chronic diseases. In the United States alone, there are about 40 million high-risk adults and another 55 million adults over the age of 65. That's a base case market of nearly 100 million people in the US, who could significantly benefit from a more reliable form of protection. And that's just the start. Add in healthcare workers, caregivers, and a massive global population in other developed countries, and you can see the scale of the opportunity. CD388 isn't just targeting a small niche, it's addressing a major unmet need in public health. So where does CD388 fit into the current landscape of flu prevention? Right now, we have vaccines, short-acting antiviral pills, and a few antibody treatments. Vaccines are the standard, but as we've discussed, their effectiveness is variable. Antivirals like Tamiflu are treatments, not preventatives. You take them after you're already sick. And while some long-acting antibodies exist, they often come with high costs and scalability challenges. CD388 carves out a unique space. It offers the season-long protection of an antibody, but with broader coverage and at a potentially lower cost. It provides the preventative power everyone wants from a vaccine, but with more reliability for high-risk populations. It's positioned as a powerful complement, or even an alternative, to the flu shot for those who need it most. This unique combination of durability, broad coverage, and predictable action is what makes it so valuable. Naturally, a premium product like this comes with questions about price and access. The proposed pricing strategy revolves around a per-season dose, likely in the range of $500. In the US market, that might sound like a lot, but for payers and health systems, the key calculation will be cost-effectiveness. If CD388 can prevent expensive hospitalizations, it could easily pay for itself. The initial rollout will likely focus on the highest risk groups first, the 𝗖𝗜𝗗𝗏𝗧𝗫 and older adults. Merck will need to present strong data showing that the drug reduces severe outcomes. Beyond that, there's another huge potential market: government stockpiles for pandemic Preparedness, a strain-agnostic prophylactic, would be an invaluable tool in the event of a new influenza pandemic. Alright, let's get into the numbers. How did Merck justify the acquisition price? It all comes down to financial modeling, specifically a method called discounted cash flow, or DCF. Let's break down the key assumptions. The model projects that at its peak, CD388 could sell 25 million doses globally each year at that $500 price point. Do the math, and that's a staggering $12.5 billion in peak annual revenue. After accounting for costs, that translates to about $5.7 billion in net income per year. But that's years from now. To find today's value, you have to discount those future earnings back to the present and adjust for the risk that the drug might fail in clinical trials. The model assumes about a 72% chance of success. After all that complex math, the risk-adjusted net present value, or NPV, of CD388 lands somewhere between $14 and $18 billion. Merck paid $9.2 billion. This means that even with conservative assumptions, Merck appears to have gotten a very good deal, with significant potential upside left on the table. What does this mean for Merck's bottom line? A successful launch of CD388 could be massively accretive to its earnings per share, or EPS. At peak, the drug could add about $1.65 to Merck's EPS. To put that in perspective, that's a nearly 24% increase over their current earnings. In the short term, there will be some costs for development and integration, but by the end of the decade, this asset is projected to become a major profit driver for the company. Now, let's play a what-if scenario. What if Cidara had decided not to sell and remained an independent company? Their value would have been tied to a series of major milestones. The big one would be the final results from the Phase 3 trial in 2027. If those results were positive, Wall Street analysts projected Cidara's stock it'd have soared to between $180 and $260 per share. By the time the drug was launched and gaining traction between 2028 and 2030, the valuation could have climbed even higher, potentially reaching $350 per share or more. This gives you a sense of the immense value that was locked inside Cidara. The acquisition by Merck allowed shareholders to realize a significant portion of that value upfront, without having to wait for all those future catalysts. So, what should we be watching for over the next 5 years? The roadmap is clear. In 2026, we'll see interim data from the Phase 3 trial. That will be our first real clue about whether the final results will be positive. The full data in 2027 will be the make or break moment. If that's a success, expect regulatory submissions to follow quickly, with a potential launch for high-risk groups in 2028. From there, it's all about gathering real-world evidence to expand its use and securing large government contracts. Each of these steps is a major inflection point that will determine the ultimate success of this $9 billion bet. Of course, no financial model is perfect. The valuation is highly sensitive to a few key variables. First, the probability of clinical success. If that number goes up to 85%, the deal looks even better. If it drops to 50%, the value gets a lot closer to what Merck paid. Second, pricing. A higher price of $600 per dose significantly boosts the valuation, while a lower price of $300 cuts it down dramatically. And finally, market penetration. How many of the 95 million eligible patients in the US will actually get the drug? The final outcome will depend on how all these factors play out. In conclusion, Merck's acquisition of Cidara and its star asset, CD388, is a bold and strategic move. It aligns perfectly with Merck's need for new long-term growth drivers and addresses a major unmet need in public health. From a financial perspective, the price appears justified, with plenty of room for upside if the drug succeeds in its final trials and achieves commercial success. The road ahead will require flawless execution, from finishing the clinical trials to negotiating with payers and scaling up manufacturing. But if Merck can deliver, CD388 has the potential to become a multi-billion-dollar blockbuster that not only boosts the companies' earnings but also transforms how we protect our most vulnerable populations from the flu. Thanks so much for watching this deep dive. If you found this analysis helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next video. See you next time.